Well, thank you for tuning in, folks. This is Tyler Mordy, President and CIO at Forstrong, and we are pleased to share with you an update for July 2019. Well, this ongoing U.S. expansion just hit 121 months old, making it the longest on record with data going back to 1854. But what's perhaps notable is how shallow the actual economic lift has been relative to other cycles. And here we see the GDP expansion since the start of each cycle and can see just how much we have lagged. Now, this has been an almost decade-long four-strong macro theme where we have repeatedly counseled clients to prepare for a longer cycle. Post-crisis recoveries are different because it takes a long time for risk appetite to return. Investors are still carrying that scar tissue around from the global financial crisis. And if you look back at the last 10 years, we've been slowly shedding the trauma of 2008, but it's been very slow going, and the period has been marked by regular bouts of panic, be it the Eurozone sovereign debt crisis, the oil crash, and other panic-driven events like taper tantrums, fiscal cliffs, trade wars, etc. We all know those episodes very well. So the key point is that the last decade has not been conducive to creating any sort of sustainable euphoria or runaway bubble-like conditions. And this phenomenon has really kept the cycle in check. So there's really no reason to expect this expansion to die of old age. Cycles typically end when an economy is either hit by an external shock like an oil price spike or when a policy mistake is made, typically when the central bank raises rates to prohibitively high levels. But with the Fed easing and now Trump pulling back from the trade war, it just doesn't seem likely at this stage. And you've seen economies like Australia and Britain, intrinsically much more cyclical than the US, have grown without recessions for decades. So we think this can be the case here as well. Um, Meanwhile, the first half of the year has been again marked by another period of financial panic and an almost rabid hunt for safety in portfolios. Here we see global equity outflows hitting the largest reading on record ever. And plenty of other indicators tell a similar tale. Fund flows out of equities and into the safety of bonds is the most extreme in more than 15 years. The very comprehensive fund managers survey from Bank of America Merrill Lynch shows similar pessimism. Cash allocations are one of the highest in 16 years. Equity allocations are the lowest since the bear market bottom in actually March 2009. And fund manager allocations to bonds is near an 8-year high. So these are simply not end of cycle readings. Remember, cycles end on euphoria. Today we have the opposite, which suggests a continued upside tailwind for equities and a strong headwind for bonds. So what's really happening? Actually, the slowdown we saw in the first half of the year, no doubt driven in part by uncertainty surrounding trade wars, is now giving way to stabilizing growth. And this chart shows the latest OECD leading indicators and a few things to note. First, the global growth scare was real for the first half of the year. The global leading indicator weakened to levels last seen in 1998, 2001, and 2008. But here's where it gets interesting is the diffusion index, this is the red line, which measures the number of data points that are moving higher versus lower, has increased for 6 months in a row now. And this indicator typically operates with about an 8-month lead on the global composite leading indicator. So the probability of actually a reacceleration in global growth in the second half of 2019 is very high. Now, an important trend that can't be overlooked is that central banks have responded to this first half slowdown. Not only has the Fed done a complete 180 in terms of its monetary policy outlook, with the so-called dot plots indicating rate cuts this year, but also globally central banks are indicating rate cuts. Here we see that Asian interest rates have been normalized to a significant degree since 2013, so they've been raised. But currently, we've got lower inflation figures than we had back in 2013 and the years before that. So Asian central banks really have room to deal with potential downside risk to growth, and they can preemptively lower rates. They've got lots of room to do that. So remarkably different from expectations in late 2018, a new global policy easing cycle is upon us. Now, all of this is very similar to the post-crisis corrections um, that we saw in 2011 and 2015. Each of these coincided with a significant economic downturns and adjustments. Expectations were lowered, valuations were improved, and importantly, monetary policymakers learned those painful lessons that economies remain vulnerable and must be supported by dovish policy. So looking back, each of these periods provided renewal and rebirth, breathing life back into what we now call born again bull markets. We've had a few of these, so we think this episode will be no different. Now, turning to client performance, most markets, stock and bond, have been soaring this year, so no surprise that our portfolios are also doing well in absolute terms. Year-to-date figures are good, and importantly, our longer-term record remains stellar, And as many of our clients will know, Forstrong's performance style is global diversification with a focus of low downside protection. And a big part of this approach involves orienting portfolios to the world's super trends, as we call them. And from time to time, markets do shift to new regimes, and we reposition portfolios to capture those new tailwinds. That can mean some underperformance, like we've had this year, as markets adjust to these again these new regimes. So now is one of those times where we believe the broad outperformance of U.S. equity markets and the U.S. dollar is starting to change. Many of the tailwinds are now changing to significant headwinds. Now, this slide says it all. U.S. equity outperformance over the last decade is at an extreme relative to other regions in the world, including the broad group known as emerging markets. And this is very likely shifting simply because several key drivers of U.S. equity outperformance are going into reverse. Some of these are valuation driven, like an expensive stock market and currency. Some of them are more behaviorally driven, like high expectations leading to a greater chance of disappointment. And another is more strategic in nature, resulting from the US's enthusiasm for what we call trade brinksmanship, which will almost certainly be self-defeating in the end. And if you think about it, the new US policy stance has already done a lot of damage and diminished the country's attractiveness as a destination for foreign capital. We see that in steadily falling foreign direct investment. But the larger costs may ultimately accrue from the pivot of America's foreign partners. Many of these countries have reluctantly come to the conclusion that the US is a source of risk rather than reassurance, and they're beginning to develop alternative systems to reduce their exposure to the US. This can take the form of accelerated trade deals without the US, funneling payments, settlements outside the US banking system, and just generally diversifying away from trade with the US, establishing different supply chains and so forth. So for global money managers now, the risk reward balance is now heavily tilted in favor of increasing exposures into markets outside the United States, where valuation and expectations are far lower, but actually growth prospects and corporate earnings growth are actually far higher. This includes Europe, Japan, and especially Asian emerging markets. So this is exactly what we've been doing in client portfolios. As you can see in our global asset mix positioning, our largest convictions and the team's largest convictions are underweight the United States and overweight international stock markets, with an overall risk-on bias for equities over bonds. And, talking about my previous comments, it's consistent with a maturing but non-recessionary outlook. And as mentioned, global investor sentiment that is completely beat up and therefore ripe for upside surprises. We strongly believe this will be a winning playbook, but we'll obviously continue to monitor any risks and then importantly, global risks to that perspective. Also, for more information on our portfolio positioning, you can always follow our monthly portfolio update, which outlines key themes and holdings. That publication is available on the website or from any Forstrong professional. And please visit our Global Thinking blog, which contains all our media and publications. We're also really pleased to announce the launch of a new Forstrong podcast, which will feature interviews not only with myself, but also with a wide variety of other members of Forstrong's investment team. So thanks very much for listening, and we look forward to updating you again soon.